On June 26, 2026, the Tokyo market suffered one of its most violent sessions in history. In this video, we perform an anatomy of that crash. Our goal is to separate the mechanical panic, the kind driven by algorithms and forced selling, from the structural reality of the AI semiconductor market. Because what happened today was less about the death of a story, and more about a market that had simply run too far, too fast. First, the shock itself. The Nikkei 225 closed at 69,360, a fall of 4.15%, or 3,005 points. That is the third largest single-day point drop in the index's entire history. The critical psychological support level of 70,000 was decisively broken, and in a single session, the market erased virtually the entire surge it had built the day before on Micron's blowout earnings. But the most revealing clue was not the index level, it was where the money went. The single most traded asset by volume on June 26 was not a hot tech stock. It was the Nikkei 225 Bear 2X ETF, ticker 1360, a product that profits when the market falls. Around 348 million units changed hands, far more than any individual AI name. This was a textbook flight to safety, with traders aggressively betting on further downside. So why did it break? Three triggers combined into a perfect storm, a mix of external shocks and a fundamental paradox sitting at the heart of the AI trade. Let's take them one at a time. Trigger 1, a pullback in US tech. The catalyst was Apple, which announced steep price increases for its iPads and MacBooks and then slid more than 6%. The implication was bigger than one company. The market began to realize that soaring memory and storage costs will squeeze margins on consumer hardware, and that fear triggered broad profit-taking across Wall Street that flowed straight into Tokyo. Trigger 2 is the central paradox. Micron had just reported a record quarter, revenue of $41.4 billion, up more than 4 times year-on-year, alongside roughly $100 billion of long-term take-or-pay contracts. The good news? HBM, the high-bandwidth memory that powers AI, is completely sold out through 2026 and oversubscribed for 2027. But here is the twist, that very strength sent memory prices soaring, and HBM consumes about 3 times the silicon wafer area of standard DDR5. As hardware costs inflate, the market suddenly feared that big tech might be forced to slow its AI capital spending. Trigger 3 was a reality check on OpenAI. The New York Times reported that OpenAI is considering delaying its IPO to 2027. Its 2025 losses are projected to reach an astronomical $39 billion, with operating costs running at about 260% of revenue, and advisors reportedly deemed the $1 trillion valuation target unfeasible for now. The collateral damage hit SoftBank Group, which has committed $65 billion to OpenAI. Its shares fell as much as 14%, closing down 12.53% at 6,226 yen, and dragging the Nikkei down with it. Now, the mechanics. Why did this translate into a 3,000 yen index move? Because the Nikkei has become structurally top-heavy. The vast majority of its spring rally, from April to June, was driven by just a handful of mega-cap stocks. Semiconductors alone make up roughly a quarter of the index's market cap, and up to 35% if you include peripheral tech. So when algorithmic and passive selling kicks in to cut risk, that extreme concentration forces the whole index to collapse mechanically, regardless of any single company's fundamentals. This was the unwinding of an AI theme, not a rejection of Japanese equities. Let's look at the casualties, one by one. First, Advantest, ticker 6857, the AI tester. It is the poster child of the rally. Testing complex HBM memory drives immense revenue, with operating profit guided up 44.7% to 1.12 trillion yen. But trading at a peak price-earnings ratio of around 60 times left zero margin for error. It closed at 32,440 yen, down 9.6%, a classic victim of valuation gravity. Second, Kioxia, ticker 285A, the NAND memory giant, and the most direct victim of the memory paradox. Before the crash, Kioxia had run up at a blistering pace and was severely overheated. So once macro fears appeared, the OpenAI report became the trigger for pure technical profit-taking. Trading value was the highest in the entire market. It closed at 92,180 yen, down 11.24%, the worst faller of the four. Third, Fujikura, ticker 5803, the data center connector. It is the symbol of connecting AI, the optical wiring that links data centers, and its market cap had recently topped 10 trillion yen on record operating profit forecasts, up 39.2%. The fact that it fell too, closing at 6,131 yen, down 4.7%, proves the sell-off extended beyond computational chips into the physical infrastructure layer. Fourth, Murata Manufacturing, ticker 6981, the MLCC supplier. Murata makes the foundational electronic components, multi-layer ceramic capacitors, for servers and smartphones. It is not a chip maker, but a supplier to the foundations. Its steep drop, closing at 10,770 yen, down 8.9%, tells you this was a wholesale, indiscriminate risk-off liquidation across the entire tech supply chain, not targeted stock picking. So where do we go from here? First, the bear case, the ceiling theory. Are we at the end of the AI supercycle? Bears point to three things: valuations priced for perfection, with multiples stretched to around 60 times for Advantest and 80 times for Murata; the OpenAI warning, where $39 billion in losses raises existential questions about whether AI monetization can ever justify this capex; and downstream compression, where inflated memory and NAND costs eventually eat into the margins of hardware makers and limit future orders. Now the bull case, the dip theory, a mechanical speed bump in a structural boom. Bulls point to Micron's $100 billion floor, those take-or-pay contracts that lock in buyers and guarantee margins regardless of price swings, breaking the historical boom and bust cycle. They point to HBM being sold out for 2026 and oversubscribed for 2027, which makes AI memory demand structural, not cyclical. And they point to forward growth. The Semiconductor Equipment Association of Japan projects Japanese equipment sales will keep climbing. Look at the reality of demand. The Semiconductor Equipment Association of Japan, or SEAJ, forecasts equipment sales of 5,500 billion yen in 2026, a rise of 12%, and 5,610 billion yen in 2027. In other words, while the stock market reacts to daily headlines, the physical build-out of AI infrastructure continues to project double-digit growth in the year ahead. Let's synthesize, separating signal from noise. The bears say the AI narrative is collapsing. The bulls say this was simply a mechanical unwinding of overcrowded, algorithmic positions. The bears say high memory prices will kill AI capex. The bulls say the take-or-pay contracts prove big tech will pay whatever it takes. And where the bears see proof that AI monetization is failing, the bulls see a strategic delay, OpenAI buying time to solidify its custom silicon, its new Broadcom-built inference chip Jalapeno, and its capital structure before the scrutiny of public markets. So, the verdict. June 26 was not the end of the AI supercycle. It was a violent, mechanical recalibration of a market that ran too far, too fast. The chips, after all, are still sold out. To survive the next phase of this market, investors must stop watching the daily index movements and start watching the physical supply chain. This video contains AI-generated and AI-edited information, and forward-looking views include AI predictions. It is not investment advice. Please make any decisions at your own responsibility.